Welcome to the Scientific Sense podcast, where we explore emerging ideas from science, policy, economics, and technology. My name is Gil Epen. We talk with world's leading academics and experts about their recent research or general areas of topical interest. Scientific Sense is an unstructured conversation with no agenda or preparation. We cover a wide variety of domains where new discoveries are made and new technologies are developed on a daily basis. We are most interested in how new ideas affect society and help educate the world how to pursue a rewarding and enjoyable life rooted in science, logic, and information. We seek knowledge without boundaries or constraints and provide unedited content of conversations with researchers and leaders who love what they do. A companion blog to this podcast can be found at scientificsense.com, and this podcast is available on over a dozen platforms and directly at scientificsense.net. If you have suggestions for topics, guests, and other ideas, please send them to info@scientificsense.com, and I can be reached at gil@epen.info. My guest today is Dr. Rouben Indjikian, who is an adjunct professor teaching energy, commodities, trade finance, digital economy, and international economics at Webster University in Geneva, Switzerland. Dr. Indjikian had a distinguished career of nearly 30 years at the United Nations Conference on Trade and Development, where as an economist and a manager, he was in charge of analysis, policy advice, and technical assistance in the areas of international trade, finance, e-commerce, and commodities. Welcome, Rouben.
Thank you for inviting me to your podcast, Jill.
Absolutely, yeah. So I would like to start with oil prices. This is something that you have been studying for a long time. A lot of things have happened, I would say, last 40, 50 years. Could you give a sort of a quick history of oil price movements and the reasons for it over the period of time, as well as what happened last 6 months, 9 months as well?
Sure. This is one of the most fascinating commodity markets, a unique commodity market, which was dominating the news on prices related to commodities since ages. The oil market became so important because in the 20th century, the oil became the main energy source in world energy consumption. It went up until 50% of all energy consumption in the world in mid-70s, at the height when the famous oil crisis started, when OPEC countries and in more correctly OPEC, Organization of Arab Exporting Oil Exporting Countries, announced embargo related to the Arabo-Israeli conflict in 1973, and that triggered a new stage in the history of oil prices. But interestingly, unlike other commodity markets, where there are some commodity markets which have their commodity bodies like cocoa, coffee, or non-ferrous metals, but they are playing these days a role of just a center of collecting information by these commodity market producers and consumers or exporters and importers, statistics, analysis, but they do not play a role in prices. The only commodity market where there is an organization of commodity exporting countries which still plays a role which plays a role and represents a factor of price formation is OPEC, is Organization of Petroleum Exporting Countries. However, let me start from the beginning of the 20th century, because this is really exciting story, because everybody are calling this a cartel in Western press, but this cartel were preceded by much more powerful cartel, which was actually controlling the prices. And OPEC was founded in 1960 by a few developing oil exporting countries, which, by the way, included Venezuela. They came to Baghdad, Iran, Iraq, Saudi Arabia, Venezuela, Kuwait, and they formed OPEC. And that event went unnoticed. Why? Because in 1960, there was no market for oil. The market for crude oil was divided between leading international oil companies, well known as Seven Sisters, which agreed between themselves long ago before that. In 1928, in Scotland, Achnacarry, it was an agreement between Royal Dutch Shell and Exxon CEOs to control prices and to defend their market shares, because they saw the threat, in fact, of Soviet Union coming back to the oil markets in 20s. And this cartel agreement stayed until the beginning of the 70s, in fact. It survived the Second World War, and it had other majors joined that cartel agreement. And basically what they did is that they maintained the price of around $3 per barrel, which in fact formed one of the pillars of one of the two anchor prices in the world economy. One price was price of oil, which was stable, $3 per barrel, and another price was price of dollar, which was the result of Bretton Woods agreements. And these two anchor prices and their stability permitted the so-called golden age of capitalism and dynamic reconstruction of Europe and development of the world economy at quite high pace. And it is, as I said, is known golden age of capitalism. In early 70s, two major events triggered the complete change of the functioning of the world economy. First, President Nixon delinked dollar from gold, and the dollar gold standard ceased to exist. In fact, the announcement was a temporary floating of dollar until the situation will stabilize. And as we know, it never stabilized, and we entered into the floating exchange rates world. And the second trigger was this OPEC ability to increase prices from this famous $3 to $11. It was a fourfold increase. So as a result, it was a first oil price shock in the world economy. As I said in the beginning, by then, the world energy has been based basically on oil. And the famous book of Daniel Yergin, The Price, called one of the prominent authors on oil, called 20th century the century of hydrocarbon man. It means that we were all very dependent on oil. And at the height of that dependence, we got this price shock, which was triggered by OPEC. And the OPEC member countries were themselves very surprised by such a level of success. And then they entered into uncharted waters of how the price would be governed from then, because before it was seven sisters, as I said, seven big oil corporations. So OPEC tried different models of price formation, netback pricing, controlling price. And meantime, from the middle of 70s, the national companies of OPEC countries, which basically says their national oil resources, they started to enter themselves into the markets, trying to sell the oil not only to these seven sisters, but themselves to the consumers or to the other actors which emerged at that time. The famous oil trading companies started to actually develop at that time. In other words, they found this possibility to enter into the market, which was before totally controlled by seven sisters. In other words, there was no market. They were vertically integrated companies. They were producing oil in developing countries, including OPEC countries. They were themselves transporting this oil to their own oil refining factories, which were mainly in consuming countries in Europe and in the USA. And then they were distributing the oil products to the population at large. We all, until now, we see Shell and BP stations. So, and then as the OPEC countries had to sell themselves, but they didn't have the distribution, their own distribution systems, they still continued to sell their own oil to Seven Sisters, but also to other companies and other traders. And 70s was also the period of the emergence of oil trading companies, which were specializing on managing the risk of oil trade, basically, from producers. They were trying to make sure that they can buy and sell at low margins and still earn money. One of the most famous oil traders was Mark Reach, the famous personality who was living in Switzerland, who was wanted by US authorities, and who got the pardon of President Clinton at the end of the century. He gave a birth to two biggest oil trading company, and namely Glencore and Trafigura. So what they were doing at that time, and the oil trading trade financing, which Geneva-based banks started to give to these traders, which had very small capital, but the Geneva-based bankers, and I knew the creator of that model, Monsieur Weyer. He was working in BNP Paribas, and he started to give financing to traders with very small capital by controlling the collateral rather than controlling the corporate risks.
So just one quick thing, Rouben. So the oil trader is a pure intermediation between the producers, and the intermediation is completely in crude oil, right?
It was also in oil products, of course, it emerged, but mainly in 70s, it was mainly crude oil, of course. And it was optimization of trade flows and playing on that differences. They didn't have assets, big assets of oil fields and refineries. They started to get these assets later when they became bigger. But what is important is that at that time, the oil price regime was was not really formed as it is now. In other words, it was not based on futures markets and futures prices, but it started that process in 80s, mainly thanks to the oil traders, which started to trade and use derivatives in Rotterdam, and then it became two biggest markets in New York and London. There was a lot of liquidity. So these prices started to be defined by a futures price system, and they were started to be determined around two biggest benchmarks. One was Brent, the sorts of oils which are in North Sea, and another was WTI, West Texas Intermediate, which was the famous crude oil of the United States. And they started to be traded in NYMEX and in ICE and through derivatives. And this commodity market-based price formation system took over the price formation from OPEC, which couldn't handle that issue in 70s and in the first beginning of 80s.
Yeah.
So since the mid-80s, the prices of oil are governed by the system of futures prices. It is interesting because other two hydrocarbons, coal and gas, have different price regimes. Coal, for example, is not really present in futures market. It is so-called forward market, over-the-counter OTC market regime, where prices are formed in the main ports of export of coal, and the prices are reported by price reporting agencies like Argus.
Is it because it's just the volume? That the volume in crude oil allows more of a standardization of the forward contracts into the futures market, or what is causing coal not to have futures?
Yeah, because coal doesn't have such a big history behind it. Coal is produced in coal is mainly for domestic production. It recently became an exporting, more actively exported. And the market participants, and there was no the history of concentration and major power playing a role, one thing. And then it was much less sophisticated than oil. The same is true for natural gas. Natural gas has, in fact, three price regimes. And it represents, in reality, three markets. North American market, continental European pipeline market, and the LNG market, which is mainly the Qatar and LNG sold to Far East, Japan, Korea, and this is the third price regime. But the most integrated energy market with sophisticated instruments of price, futures, is only crude oil and oil products. And this futures market need liquidity and need supply and demand and market participants who will engage in developing these futures contracts, because they are emerging and they are developing. Some futures contract emerged but didn't really develop. Others did. So the most famous futures contracts are Brent and WTI. And they are known as benchmark prices because there are 100 sorts of oil which are sold in international trade, but the price formation, the price formula in contracts is based around the premiums and discounts around two benchmarks. So if an African oil exporter is selling, for example, to China or to the US, the price for buyer, the price formula is either mainly it is Brent, because it is the biggest global benchmarks, but it could be also WTI. And then they say that their crude oil has either premium over the benchmark. Normally, it should be a lighter oil with less pure lighter oil, or discount. Normally, it is heavy oil with serum in it, so it is sort of with lower yield of high quality oil products.
Yeah.
So in this case, the price formula is very important. But the main prices which you see on the television screens is Brent and WTI.
Yeah, yeah.
When you look business chains, they give the price of main currencies, the price of gold, and the price of oil. And in the price of oil, they give a price of Brent and WTI, which are the benchmarks.
So we had some major shocks in the 80s, and then the oil prices got fairly volatile, right?
Yes. And, commodity prices.
Go ahead.
In fact, I worked nearly 30 years in UNCTAD, United Nations Conference on Trade and Development. UNCTAD was created by famous Argentinian economist Raúl Prebisch. And one of the main reasons of creation of UNCTAD, according to him, was the attempt to stabilize prices of commodities markets. Because according to his theory, the commodity exporters are, in a long-term, secular term, are losers in terms of trade vis-a-vis manufacturers, exporters. Because while the manufacturers' goods are priced as a markup reflecting the inflation rate global, the commodity prices are very volatile and unstable.
Yeah.
And that is because of the characteristics of commodities, mainly a very low short-term price elasticity, both from demand and supply sides.
Right.
But without going into technicalities, Raúl Prebisch thought, and they used the famous concept of the buffer stocks, which was discussed in UNCTAD nearly 20 years. UNCTAD was created in 1964, and in 70s, 80s, member countries of UNCTAD, which are the member countries of the UN, basically, were discussing integrated commodity program, and that was triggered also because the oil price revolution in 70s, which was considered as a big success of developing countries, was created a lot of enthusiasm among developing countries, especially in the UN, and they announced the new international economic order, and they thought that they can have much stronger position in world economy, and that commodity exporters can repeat the success of OPEC. That didn't happen, but this idea of stabilization of commodity prices was so deeply ingrained in the heads of people that it became a matter of intergovernmental serious negotiations from 70s and 80s. And in fact, the first theoretician of this concept was famous Benjamin Graham. The guy who, Benjamin Graham, is the author of the investment guide for all investors in equity and bonds, in assets. And his book, Warren Buffett was his student, but he's less known as the author of the buffer stocks. In 2 words, the idea of buffer stocks was the following, is that as everybody knows that the prices of commodities, including crude oil, are unstable, in order to decrease that instability, exporters and importers of a given commodity, let's think here about oil, are agreeing between themselves that they will regulate supply and demand through the mechanism of buffer stocks. In other words, when prices are low, this agreement between exporters and importers, which should be financed because it is about creating big stocks of crude oil in both exporting and mainly in importing countries, but of course with the participation of exporters, because exporters can just cut the production as OPEC is doing. But the importers need to have enough stocks. So when the prices are low, the buffer stock system buys from the market.
That's like the strategic oil reserve in the US.
Yes, like they and commercial also add to it also commercial stocks, and imagine that they are buying, and in fact they are doing when the prices are low. For example, Chinese bought a lot of oil because the prices were low. When they buy this oil, they create more demand. That increases prices. When the price is becoming too high, then the managers of these buffer stocks are starting to release that commodity, in this case oil, into the market, thus increasing supply and bringing down the price. So when the price is low, you push it up. When the price is too high, you bring it down. So you create a ceiling and floor to the prices, and the volatility of prices is becoming much less. That was the concept. But that demands a real coordination and cooperation between exporters and importers. In real world, they are competing with each other and they are taking an advantage. So it's these 20 years of negotiation didn't bring any result. Meantime, markets found the solution of managing the price risk instability through hedging. In other words, you cannot influence overall price movements in the market. What you can do is you can manage the risk of your individual contract by hedging against that fluctuation, so that you, and mainly that is the business of traders, will protect your margin during moving your tanker from producing country to consuming country, and you are not afraid that the prices are changing because you already hedged that. In other words, you transferred the risk from the trader with commercial interest to the speculator who wants to take that risk and bet on the movement of prices.
Yeah, so if you fast forward, Rouben, to the current time, so OPEC still exists. There are more players in there now, not in OPEC, but Russia is a major player. United States has a lot of production, but they make decisions not in a coordinated fashion, because coordination is often difficult, as you say, because they're also competing. And that has brought into the market fair amount of volatility, right? The prices have jumped around between 100 and more, most recently negative prices.
Exactly. So what happened is that OPEC institutionalized itself and still was playing a role in giving the signals from the exporter side how much they will produce into the market. And these signals were influencing prices. So OPEC policy measures OPEC was a price taker, but OPEC was also a price influencer when they were managing to coordinate their actions. But it was not always the case. Two major famous decisions by Saudi Arabia to stop managing the production, in other words, limiting, in other words, cutting the production, was the decision by them in 1986 and in 2014. In both times, for different reasons, they decided that they no more cut the production, and they started to produce as much as they can into the market, and of course the prices collapsed.
Yeah.
But in a longer period of times, there was an agreement between OPEC members, which was announced, and all market watchers were looking after the announcement of OPEC, whether they are going to maintain the production, cut the production, or increase at what degree. And that immediately was translating into the level of prices. Now, what happened is that the OPEC member countries and non-OPEC oil exporters realized that they are in the same boat.
Yeah.
And at the end, Russia started to agree, invited to OPEC meetings, and to agree with OPEC member countries to manage the supply of oil. And that formula was called OPEC Plus. In other words, OPEC Plus, Russia and others. Moreover, when coronavirus happened, and it was an unprecedented event when governments who are supposed to support the market economy, from the liberal point of view, they should let markets to function. From the Keynesian point of view, they should keep aggregate demand at high levels so that crisis will not happen. But what governments did, they stopped the economies because of coronavirus. And that collapsed the demand on oil. And at that time, there was a very interesting episode in March when Russia, in the early March, went away from OPEC meeting, and that created a conflict between Russia and Saudi Arabia, and Saudi Arabia started a price war at the most unfortunate time, just in the beginning of coronavirus. But it took for them few days to realize that it was the worst time to have a quarrel, that they have to come back to the negotiation table and try to save the situation, which they did, in fact. And OPEC and plus Russia, together, they cut the production by 10 million barrels per day. 10 million barrels per day is 1/10 of the supply and demand of oil. It is around 100 million barrels per day. So it was a major act. Moreover, this United States, which is officially has nothing to do with the OPEC Plus, and in Western economic literature, OPEC is known as a cartel. And we know that there are anti-cartel legislation and competition legislation in all developed countries. Basically, what they do, if they were private companies, would have been considered as illegitimate, as acts which can bring an action of the government. But as they are intergovernmental organization, they are not subject to these anti-competition laws in Western countries. However, the US politicians, US Congress, and even White House, they loudly said that they would love to see that oil producers will cut the production because the situation is disastrous. So they openly supported the coordination between OPEC and Russia in cutting the production in a situation when there was a collapse of demand for oil. And we had this unique situation on April 20, when this is why it went down to minus 40, because this is the techniques of selling WTI in futures market, is that every 20 of the month they have to sort of clear the situation and know whether they are buying or not the oil which are in the futures contract and which are expiring.
Mm-hmm.
So when these people who had at their hands futures contract, which they didn't resell, and they had to take a delivery, and technically all stocks were booked, and there were no free space to just park this crude oil. They started to pay to those who can take this oil and put it as a stock.
Right. So really kind of paying for storage.
Yes.
Yeah.
As you were paying for a storage, the price you paid represented this minus price, and at the extreme case, somebody paid 40. Okay.
Right.
But then in this situation, it didn't happen with Brent, but it happened for one day but now the price is again around $40, $50, $45 per barrel, which is showing that the world economy is starting to recover. People start to drive cars, but people still do not travel by air. So the situation is still very dramatic.
So very quickly, Rouben. So there are a lot of things going on, right? There is shale, there is natural gas, electric cars are becoming more prevalent. The effect of crude oil in the total energy consumption appears to be declining. So what do you see as you look forward next 10 years? I would imagine that the price instability that we see would continue in the absence of any coordinated efforts. But what do you see in terms of both the effect of crude oil in the world economy, as well as the pricing regimes that we can expect to see in the future?
Well, the energy production and consumption reflects the state of the world economy, its growth, and its dynamics. So there are a lot of forecasts about the post-coronavirus world. And the longer it goes, the more pessimistic they are becoming. Before it was a V-turn, then U-turn, and now they are speaking about L-shaped situation, which means that the behavior of households and companies is becoming too conservative because they have very low expectations, and they became much more frugal. They don't buy things, and as a result of that, the outlook for the energy consumption, overall energy consumption, is still quite negative in coming couple of years.
Right.
But at the same time, there is a lot of discussion about policy changes towards a more greener economy after the coronavirus, which is not directly linked to the coronavirus, but which is a sort of a trigger to reconsider our values, our future, and so on and so forth. So in this case, we may have a lower energy consumption because of the behavior of households and corporations. And for example, if corporations will decide that more employees can work from home, then there is a less need for buildings. Right. Commercial buildings. And in energy consumption, the buildings are playing a very important role because we are using electricity, heat, and cooling mainly in buildings where we live or where we work. So basically, the use of these buildings is very important. But from the point of view of the structural change of energy consumption from hydrocarbons and especially coal and oil, with gas as a transition energy because it is cleaner than the other two, and towards renewables, is already announced. There is nothing new about that. It is already announced policy uh, by at least developed countries, but also by China. And I'm sure that after some time, it will be also announced by India. However, the question is how much the policy announcement of governments is corresponding to the reality of the energy production and consumption. To my mind, in spite of Paris Accord and agreement of countries to control Paris change, the governments are really lagging behind in managing this process. And the world is just, we're just doing business as usual. Of course, there were some subsidies to help renewables, but the change in the balance, which is energy system, is very conservative and it has a lot of inertia. The drastic change towards renewables from oil and coal looks to me not very practical. However, with coronavirus and the new policies, there may be a little bit more acceleration in terms of structural change in world energy towards more sustainable energy use. And also here we should think about innovation and efficiency of energy use with traditional energy sources. In other words, for the production of each dollar of GNP, you use less energy because of energy efficiency methods, the use of Internet of Things, and new technologies which permit to burn much less energy in order to meet our needs, and much less waste, of course.
Yeah, I think it'll be interesting. So some of the factors that you mentioned, we need less need for commercial buildings, we need less need for travel, both terrestrial and air traffic. All of that is going to possibly reduce the consumption part of this equation, the demand part of this equation, which could have a negative effect potentially on how renewables are, kind of replacing oil, because there was lot of acceleration of renewables when demand was going up. It's unclear if the same will happen where the demand is trending down.
You raised a very good point, but I think in this case, at least developed country governments may choose to regulate these markets by incentivizing producers of renewables so that they can accelerate the structural change rather than let them to react to the market signals of prices and demand. The reality will be a mix of both. They will, of course, struggle for bigger market share in the circumstances of lower demand and probably lower prices. But at the same time, they will ask governments to help them to sustain this transition period.
Yeah. This has been great, Rouben. I really appreciate the time that you spent with me, and good luck with everything that you do.
Thank you.
Thank you. Bye.
Bye.